Hi, I'm Todd Rosenbluth, Head of Research at VettaFi, and today we're talking about international index investing. I'm joined by Arjun Kapoor of iShares and Anna Harris of MSCI. Thanks for joining me.
Hi there.
Hi there.
Well, it's great to have you here. So, Arjun, let me start with you. Why do you think investors look at ETF flows, and what does it tell us about investor sentiment?
Sure, Todd, and real pleasure and honor to be with you today. So ETF flows are a useful reference point to gauge investor positioning in the market, given the liquidity, the cost effectiveness, and transparency they offer to investors across asset classes and geographies. Flows come in many shapes, sizes, and sentiments, and for the savvy investor who can interpret them, they may prove a useful lens into investor positioning. And unlike other popular positioning metrics, such as futures net length, option skew, and others, ETF flows are unique in the diversity of investors behind them across retail and institutional client channels. So many times flows chase performance, but sometimes they show investors buying the dip in a certain exposure. They can also be used from a contrarian perspective, giving a lens into where positioning may be crowded and where certain exposures may be under-owned, depending upon one's investment thesis.
Well, that's great. So, Anna, let me bring you into the conversation. Let's talk about MSCI's international indexes, and maybe you can just set the stage for the developed versus emerging market benchmarks.
Sure, Todd. Again, it's a pleasure to be here today with you all. So as roughly at half a point of this year, MSCI had around 13.5 trillion of assets benchmark against MSCI index across both active and passive funds in terms of equities. From an ETF perspective, looking at a more recent data point at the end of last quarter, MSCI is roughly around, let's say, 470 billion tracking EFI indexes, so a world ex-US, while approximately 200 billion are tracking emerging market indexes. This variety of indexes and investors does give us a good window to how investors are reacting to any kind of market events.
So, Arjun, at the end of the third quarter, what was the state of affairs for the equity flows, and do you finding that investors were preferring developed over emerging market ETFs?
Sure, Todd. So the S&P 500 has been down every quarter this year. That's the first time it's been down 3 quarters in a row since the aftermath of the global financial crisis in 2009. Thus, it's been a historically challenging market. And amidst this volatility, driven by well above trend inflation, hawkish central banks, and geopolitical shocks, we've seen investors turning toward the ETF vehicle as their trading tool of choice. So in the first 3 quarters of the year, ETFs have traded 32% of the overall US equity tape. And for reference, ETFs only made up 25% of the tape in 2021. So as well as strides against other trading vehicles, ETFs have also made gains against themselves. So in 2022, total ETF volumes of 36 trillion have now surpassed 2021's full year total. Part of the reason more trading has taken place via the ETF wrapper is likely because liquidity elsewhere has been declining. So as volatility climbs, bid-ask spreads tend to widen in single stocks and bonds. So to your question on developed versus emerging markets, investors have slightly favored developed markets amidst this global volatility. So we've seen over $2 billion going into our core MSCI International Developed Markets ETF and $2.9 billion going into our core MSCI EFA ETF. And only $2.1 billion has gone into our core MSCI EM ETF. But what we've seen is that investors are not only being choosy across geographies, they're also taking preferences across factor-based strategies. So investors have preferred the minimum volatility strategy across geographies to limit the sharp drawdowns in the market we've seen this year. And so in the first 3 quarters of this year, we've seen 2.5 billion of flows into our MSCI US Min-Vol ETF and $3.8 billion into our MSCI Emerging Markets Min-Vol ETF.
So, Anna, Arjun talked about the environment from a volatility perspective. This has been a tough year for global equity markets. Let's just talk about the global macroeconomic environment and what role you think that's played in terms of flows.
Sure. So, as Arjun mentioned, it hasn't been an easy market to navigate. Geopolitical risks continue to be in place, sometimes escalating, which, coupled with stubborn inflation driven by higher energy prices, higher food prices, is making investors nervous and less willing to take risks. This translates into two trends that we've observed. One is higher than average cash balances, and two, as Arjun already mentioned, a shift towards more defensive exposures across asset classes. So what we've seen so far that is even if investors are committed to an asset class, they have favored a more defensive stance or lenses to that investment. For example, in developed market equities, there have been higher flows into US equities compared to EFI or the rest of the world. And within equities in general, more defensive exposures like minimum volatility or defensive sectors have captured a greater share of the flows. One thing that I also would like to highlight that is where an area that we've seen resilience in terms of flows has to do with ESG and climate. Again, despite market volatility, we've seen continued flows into these ETFs across asset classes and across geographies, showing that a strong underlying trend in terms of the movement of capital to those types of ETFs and indexes.
So, Arjun, we've talked broad markets, we've talked about ESG and minimum volatility. How about single country exposures? Investors can be more tactical and more targeted with their exposure using ETFs. What are you seeing there?
So Todd, absolutely. At iShares, we offer the largest product suite of single country ETFs backed by MSCI indices. And amid the global market volatility, we've seen both retail and institutional investors utilizing our single country ETFs to trade their macro theses. So for example, investors have favored countries that are commodity exporters amid the global surge in commodity prices. So our MSCI Australia and MSCI Canada ETFs have garnered $462 million and $254 million worth of inflows in the first 3 quarters, respectively. The second theme has been the Russia-Ukraine conflict and the concomitant energy crisis impact on Europe, leading to heightened chances of recession in that region. So we've actually seen $486 million flow out of our MSCI Germany ETF. A third and final theme in the single country suite has been the strengthening US dollar's impact on international currencies and equities. So the Japanese yen in particular has experienced a significant depreciation this year, and $622 million has flowed out of our MSCI Japan ETF in the first 3 quarters of this year.
So, Anna, we talked a lot about what's happened in 2022 from flows and a macro environment. What are your thoughts as we head into 2023?
I think the outlook continues to be challenged. Despite the action of central banks around the world, inflation remains high, which has had a negative impact on consumer confidence, especially as we're getting into winter and those energy bills will continue to go up. Higher interest rates have also had an impact on mortgage payments, which are taking a greater share of consumers' disposable income compared to just the start of this year. The R word, recession, is starting to get more mentions in earnings calls, which means that companies are also increasingly more apprehensive about the near term and looking into 2023. Against this backdrop, we probably should expect investors to remain defensive in their allocations as we look ahead to the rest of the year and into 2023. That said, it's quite likely that investors will start looking for potential opportunities, valuation mismatches between asset classes, regions, sectors, and any kind of improving news flow for consumers or companies might be a trigger to assess when take more risk and potentially deploy some of those cash reserves that they've held back.
Well, thanks, Anna, to you and to Arjun for some great insights. And thank you to the audience for listening to us. Tune in next time. Thanks for joining us at VettaFi. Have a great day.
Thank you.
Visit www.ishares.com to view a prospectus, which includes investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Investing involves risk, including possible loss of principal.